going on, everybody? Welcome to Stock Trades. All right, guys. So sorry about the late start here. My apologies here, Gunslinger. My apologies. So yeah, late start today. Lots of it's been a busy day, so unfortunately couldn't I've been working all day. Couldn't be able to make a live earlier, but before I head to the gym, I wanted to just take an opportunity to do some stuff. So I didn't put this on the title. So I may make this video and then edit this to repost it regarding this event. But for folks that don't know, there was an event today, and one of our members here, Belize, attended it. And what we're going to basically be doing here, this is the Medallion Elevate meeting. Oh, I guess we already have one open. What I wanted to do is I wanted to take this opportunity to just talk about a couple of things. Hopefully the internet says the internet's slow. So hopefully you guys can hear me. I don't know why. I mean, this is like the fastest internet we have. So I don't get it, but we'll see. So a couple things that I want to mention. Overall, Clover is consolidating. When we're really starting to see some consolidation. I mean, if you don't call this consolidation, I don't know what this is. So we're consolidating near the $4 region here. So overall, the market's realizing that this thing, any opportunity this thing gets under $4, it gets bought up real quick. Now, there are a couple things we're going to talk about that I think might happen in the market. Most recently, someone just posted this. I think this is Stockwitz. Shout out to Cetoplasm. Is that it? Something like that. He said that I hate to be the bearer of bad news, folks, but we were very likely going to retest the bottom of the channel around 320 in the very near future. Short term, the chart is ugly. Long term, every earnings will bring us one step closer to the goal. This is not a get rich quick stock. It's a it's a get right slow stock, right? So, so we're gonna talk about this, right? Hey, how you doing, Pratchik? How you doing? How's everyone doing here? Sorry, guys, my allergies. I was gonna turn on the camera today. Finally, the camera is back on, but my whole left side of my eye is like allergied up. So I was like, you know what? We'll just do this later. So sorry if I sound a little weird. Allergies kind of got to me here. So, okay. So I don't know what technicals he's looking at. I haven't really honestly taken a look at it, but he's probably mentioning. Yeah, I'm not too sure what he's looking at, to be honest, in terms of the channel. But I do agree with the short-term analysis, not just for Clover, but for the overall market. Okay. So here's the thing. Right now, the market has been really resilient. I mean, just look at the S&P 500. Just go ahead, type in SPY. Overall, the S&P is up 22%. I mean, this thing has been on a rampage, right? And I'm just curious to see how the VIX looks. Yeah, the VIX went up today. Okay. So I think we may see a slow rise in the VIX as the election proceeds. A lot of folks are thinking the election is going to take more than a day. I think for Hillary versus Trump, I think the election was like the same night. I think we figured out that that Trump was going to be president, and then think for Biden and Trump in 2020, I think it took the next day or something, or 2 days after that. I'm not too sure. And in some people, it's still ongoing, right? Even we're about to start a new election. So, so I don't know when the election is going to be over. It may be a week. A lot of people are saying that it could take a week to count up all the mail-in ballots and everything like that. But the point is that I'm trying to say is I think the market's going to go up and up and up, and it's just going to be to sell the news, okay, regardless of what candidate wins. If Biden wins, if Kamala wins versus, it's crazy. I still think Biden, you know what I mean? Even though it's not, it's Kamala, and it's like, I just kind of my mind is a little twisted on that, right? Because that was a big, just a very fast, right? So how they switched it. So yeah, it's Kamala. Regardless if it's Kamala winning or if it's Trump winning, I think after that, and I could be wrong here, but I think this is what Wall Street's kind of like putting on the pool table here. I think the market's going to go down in November, right? I think we're going to get a 5 to 7% decline. It'll be a short one, okay? I think the tax loss harvesting is going to start, in that everyone's going to be excited regardless of their candidate winning and whatnot. And I think right then and there, it could be a day before the election, it could be the day of the election, it could be the day after the election. It you're going to get a, I think, down market, okay? And because November we're going to get some, because if you look at market breadth, which is a lot of technicians look at, market breadth is kind of evaporating. Okay, that's like the momentum of the market from a technical analysis standpoint. So I think, we are going to see some weakness in stocks, which if you look at the um, cash secured puts, when you buy a cash secured put, the $3.50 is actually paying, which is kind of weird considering the stock is at $4. Okay. So a lot of folks are betting that this thing could go down. Okay. And this is just the short term. Okay. And sadly, a lot of people don't watch our channel. There's going to be folks out there that you kind of like are like, oh damn, this thing's going back to like 60 cents. People freak out, right? When you remember that lecture I gave you guys on like the hormones and the neurohormones related to like the flight and fight area, like so that's going to activate in the short term. So I expect the VIX go up a little bit. I expect, the volatility index, right? I expect Clover to go down, and overall the market going down 5 to 7% because the market's been pretty resilient. Okay. Now after November, I think that's when we're going to get the Santa Claus rally, and then you're gonna start seeing like, oh my God, the market's amazing, I'm so happy, and you know how it is, the game. For folks that have been watching us for a long time, I just imagine us 10 years from now, we're just going to be like, I don't even have to say anything. You guys are going to know this whole story. Okay. So I think that's kind of the situation right now. So I think this person's right. In the short term, yeah, we may get, I don't know if it's going to go to 320. I don't care, to be honest, because, again, like I said, we are heading like you remember I told you this, like when it was at 60 cents. Remember I told you this when it was at like $1.50 and $2.50 and now $4 and now potentially, who knows, could be 320. I told you that we're, that ride that I hate Disney for removing this ride. That's ride. It's a small world after all. It's an annoying ride. I'm sad they removed it. You know what I mean? It's a good ride, right? It's beautiful. But anywho, we know where we're going. When you enter this ride, we know where we're going to go. So regardless if it's up or down, I mean, just look at end phase. How many times do we get 50, 70, 80%? We've gotten so many of those drops, right? Look at Tesla, right? So, again, it's just part of the Fibonacci sequence retracements, part of the Brownian motion of life, part of success. You get up and down, right? The short term doesn't make sense, right? Now, again, once you get really dabby in Wall Street, and I got access to institutionally graded data that I can't show you because it's a singularity type license, but I can share with you my analysis after reading all this institutionally graded data. I can come talk to you guys and say, okay, this is what I think is going to happen. Okay. All right. So now we talked about this, right? So now we kind of like mentioned this. What else? Oh, just side deviation. So, how we do the option strategy? Like, how there's like 3 stages to the Mastering Stock Market course, which is obviously embedded with the over 2.5 billion outputs of data. Just know that this thing is expiring on November 3rd. I think it's like less than, what is it? What's today? Thursday, Friday, Saturday, Sunday. So like less than 4 days or something like that. 4 days, this thing's going to expire. So take advantage. There'll be a link down below. Go to alstocktrades.com, join with the coupon code Main Street. Okay. So let's just kind of talk about this. So how we talked about the wheel strategy, right? So like, let's say, for example, let's go to Clover. Let's say Clover right now, it is $4, right? And let's go ahead and, so it's $4, right? and we go ahead and say, okay, I want to buy Clover at $3.50. I don't want to buy Clover now. I'm just giving you hypothetical. This is a hypothetical. Okay, I want to get at Clover at $3.50. Okay, now there's some people out there that do a selling order at $3.50. I think that's personally stupid. That's really stupid. Okay, most people would do, well, not most people, because most people don't know about this, which is a shame. But educated people, again, not financial advice, but just people that like to make money, right? Which is kind of the goal of the market, right? Educated people. What's up, John Speed? I see you here. Okay. They're going to go ahead and do a cash secured put. They're going to go ahead and sell a put at $3.50. Okay. And they're going to collect premium. So someone is out there going to give you money just to make a limit order to purchase Clover at $3.50, right? Which could get you down to like maybe $3.20 would be the break-even price, right? Which gets you in line with what this gentleman is saying. Okay, just food for thought. So that means if the stock goes down to $3.50, then great. Okay, that's it. $3.40, whatever. You bought at $3.50, right? And you got your premium. It's a sexy way of buying. And then you go ahead and reverse it and say you want to go ahead and do a covered call now, saying you want to do a selling order at $4. Now, instead of doing a selling order of $4, might as well make money on it. So I'm going to sell at $4. Give me some premium, man. And the premium month out is paying approximately, I don't know, 50 cents. I think in the one in December, right? 50 cents. It's so funny. We are rolling so much in the dough that I forgot that I had an extra. So the FU money side of things for the short-term day trading side, I had an extra, $4,000 I could make. And I realized, like, oh crap, I need to go ahead and file that order. So I'm gonna do that tomorrow. It just shows you like sometimes you need to have an Excel spreadsheet, because we know when you're like literally printing cash, you got to make sure, because sometimes you might you might say, oh damn, that's another $4,000 I could make right there, right? So it just shows you how fun this could be. Like, oh crap, right? When you're rolling so much in the dough, right? So there's but here's the thing. There's a dark side to this. So let's assume Clover is it drops down to $3.50. Then you do your cash secured put. Okay. And then you get at $3.50. But all of a sudden, it goes down to $3. Then it goes down to $2.50. But you held at $3.50, so you're losing money because you bought at $3.50 now. Regardless of the premium, let's say the premium brings you at $3.20. Okay? It's a 30 cents premium. Okay, guys? But it's at $3. And all of a sudden, it drops to $2.50. Then it drops to $2. Then it drops to $1.50. Right? I want to say, assume the stock price is 10. Right? We could do an example. How about this? We'll do another example. Right? Let's do another example. So right now it's 11.20, right on the intrinsic value of our most recent video that we did regarding SoFi, and we could see here this thing's gone up, right? And we called it out when it was literally on its bottoms, okay? But let's assume right now, let's do some math, okay? So let's assume we want to do a cash secured put right now at $10. Okay, great. It goes to 10. Okay, that's it. But you got your premium. Doesn't matter, regardless if it goes to 10 or not. You got your premium. It goes to $9.80. You're still a holder at $10. But all of a sudden, it starts going down. Right? Let's assume here. It starts going down to $9. Oh, okay, then it goes down to $6. But you're still a holder at 10. You see how you dropped pretty much like almost 40% in value, right? And then all of a sudden, it goes down to 5. The problem is the covered call now for the $10 is not paying a lot, right? You doing a covered call at $10.50, it's not paying great. Okay. All of a sudden it goes down to 6, to 5, to 4. The only way to do this now is you got to go ahead and do a covered call at a lower strike price than what you got in at $10. So you see how dangerous this could get. A lot of people can lose their money in the wheel strategy. Now there's ways of rolling things out and kind of rolling into it, right? But you see how dangerous this can get? This can get pretty frightening because if you do a um what you call it, a cash secured put, let's say at $10, and you get in at $10 because you want to be comfortable. What I'm trying to basically tell you is you need to be comfortable saying, I like the stock at $10. I think it's valued at $10. The problem is most people don't know how to value stocks, which is why the mastering, the way it's going to be organized on this beta access right now, is the first level is fundamental analysis. The first thing you need to learn is how to evaluate a company. You need to learn what fundamental analysis is. You need to learn what an intrinsic value calculation is, because if you don't know what the value of a company is, then what the hell are you doing in the market? Get the hell out. The second thing is you need to know technical analysis, because what's going to end up happening is you're going to look at these stocks, and you need when we do the level 3, you need to understand what delta is. You need to know what the Greeks are. You need to know what implied volatility means, right? You need to understand these terms, right? Because once you understand the value of a company, then you're like, okay, you know what? Actually, you know what? The value of the company right now, I'm just going to make it up. Forget that it's SoFi. I'm just a number right now. Let's say the value, let's say that's $7. You're like, oh, okay, well, I don't want to do a cash account, put a 10 because I think this thing's going down. And you see it's going down. You see it's going down in the channel. Like, remember when the stock was $22 and I made that very bearish video saying this thing's going to go down to $7 because it's not worth that much. And everyone in their SoFi bullish mind destroyed me, and all their accounts got destroyed, right? Those folks, if they would have done cash secured puts, let's say, they would have been eaten out. But if they would have calculated the value, it would have protected themselves from doing a cash secured put. The point that I'm trying to say is, let's assume Clover right now, just tomorrow, and went to $45. Okay. Do you think I would do a cash secured put at $40 or $35? I would not. I would not, because it's not there yet. It's growing at 11%. For it to be $40, I think it needs to grow at 25% or something like that. Something like that, right? We have to recalculate. Or I think it's like 35% for it to go to $45. What I'm trying to say is, if the company's intrinsically not worth that much, then I'm not comfortable doing a cash secured put at those levels, right? Because it could go down. Now, covered calls are different, right? That's a different discussion, right? Because if you're in a bull market, and this is a bull market, then you could do covered calls at a higher rate, and you can just basically make this money. And if you do it effectively, you can make an extra 10 to 15% on this and not have to essentially get dipped out. But that requires a lot of understanding of, that's why I haven't talked about it, right? That requires understanding of delta, that requires understanding of implied volatility, understanding of the technical analysis, understanding of the intrinsic value. You really need to be an expert here, right? You really need to know what you're doing here, okay? Which is why I'm not gonna, we haven't talked about it yet because people are not there yet, okay? So, but you have to understand what rolling is, and there's a lot of things that goes into this, right? But I just want to, because we've been talking about all the good things that can happen, right? But we also need to talk about there is an Achilles heel to the wheel strategy, which is why if you speak to any expert who does the wheel strategy, they will tell you the only time you want to do a cash secured put is if you want to get in at that price. If you like SoFi at $10, then you could do a cash secured put at 10, right? But most people that are elevated in the market, they're like, you know what? No, I like it at 7, right? I want to get in a relationship with this at 7. Okay. I don't, right? So again, things are changing up for SoFi. They're about to be profitable, they already are, and they're about to be full year fiscal profitable. So it's a different story here, but I hope this is, just, I'm getting my point across, which is why we established a platform, which is why it's important to, to build out the data that we have. Because if you don't recall, our intrinsic, our stock terminal gives you implied volatility. It gives you all that stuff, right? And it gives you everything that you need. And it gives you a community in which you can go back and forth, and it's going to give that coursework that'll take you from zero to hero. So there's a lot of stuff, because if you're not well educated here, you're going to lose your shit. Okay, it's pretty much this is Wall Street. Okay, we don't care about you, right? Wall Street doesn't care about you. All right, so Let's go ahead. Oh, I see your comment here. Al, why are you giving me clove nightmares before bed? I'm sorry. No, just a little talk, a little pep talk, right? John Speed, what's going on? Al, it's important. It's really important that people understand the short have covered 30 million since April. The rally was fueled by this. Now this buying power is over. We need news and earnings to move. TSS, you are absolutely correct. You are absolutely correct. See, the shorts slowly have been covering because they're like, frick this, right? They're looking at Palantir now at 43. They're like, okay, these companies, just the other day, Tesla was at $180. Now it's $257. Nvidia's, last, not too long ago, it was $107, $110, and now it's 140 almost, right? So the market's slowly recovering, if not really going up. Not even, I wouldn't call this a recovery. So, yes, we need fundamental news. Okay, we need fundamental news. All right, so now that we talked about this, now we got this. So now, another thing I want to talk about before we hit this right now is I want to just mention this real quickly. Is in our stock terminal, we were talking about a couple of things. The difference between using for the outstanding shares, using shares outstanding versus implied shares outstanding. So if you use the shares outstanding, it's 407 million. And if you use implied shares outstanding, you use 497. So if you haven't realized in my calculation, when we go 10 years into the future and discount back at what the stock should be worth at today's value. Yes, today's value, not in 10 years, today's value, especially if you use 11%, right? I use 497, right? Because think about this. Let's say you have a big pizza. The pizza is the size of your bedroom that you're in right now. It's a huge pizza, stuff the type of pizza that you see in Mr. Beast's videos. Okay, if you bring 497 people, are you going to have a smaller or a bigger slice? You're going to have a smaller slice because you have to share it with more people. If you have 407 people, you'll have a bigger slice. And in fact, if you bring 2 people, you're going to have a really big slice. You can practically sleep on the pizza, right? And that's kind of the idea of the intrinsic value here. So when JB did the calculation at 25% growth rate, which Clover's not growing right now at that rate, they're growing at 11%, but they said they are going to return to growth. If we do 496 million, I use 497, but 496, they get a $23.91. But if they use 407 million, they get $29.13. So you see, it increases by $5. Okay, so why? What's the difference between implied, and this is educational channel, right? So implied shares outstanding, I went ahead, said implied shares outstanding are the total shares a company would have if all of its convertible securities like stock options and warrants were exercised, reflecting potential shareholder dilution. If I was to do an intrinsic value calculation, which one would I do? I would do the one that will make my stock price higher or lower. I would go for the one that makes it lower, right? Because why is because I want to be conservative, right? I don't want sunshine and roses. I want to see the real world, what could be from what has burned and from what has underbeen, or something like that, right? I want to see that. Okay. So the thing is, right? Because I want to know that. Okay. So that's kind of the input there, right? And then later, let's assume now, let's say when would I use the shares outstanding? Okay, then that's a different question. So when would I use this section of the calculation at $29? So assume, let's say today Clover's at $24. Or let's say Clover's at $25 above our intrinsic value. Then I would say, okay, now we need to, how like a pathologist looks at different magnifications when they analyze a slide, you need to do the same thing. Okay. So you need to then go ahead and say, okay, what is the outstanding shares excluding dilution from management? Now, again, they could start exercising their warrants, especially if a stock reaches its bull case. We don't know. Right? They could start going ahead and doing these things, right? We don't know, right? So, but assume it's at 25, and I'm trying to know let's start looking at what is the value without $4.96. Then we would do this. And if you want to go specific, then it's say, okay, do they have any share buybacks? Oh, assuming they didn't use them, we know they did. This is just a hypothetical example. Oh, they got $20 million in shares buyback. Oh, $20 million? Okay, so 20 million divided by $25. They could buy back 800,000 shares. Oh, they're obviously going to buy more because it's $4, not 20. But I'm just giving you an example. Then you would decrease this by another million, right? To see kind of where we're at. Okay. Then you would, you get what I'm trying to say? Once we know the value of the company, then we can move on to level 2, which is technical analysis. Then we can move on to level 3, which is when do I do my covered call, right? So I don't get exercised out because I know what the value is. Are you starting to see what I'm trying to say? If not, it'll take time. All right, so there it is. But the problem is you can't do any of this without this data. That's the sad part, right? You can't do any of this. It took, you can't do anything that I'm saying. I mean, you can, but you good luck, right? Right? You can't do any of that without having an educational platform. You can't. It's difficult, right? All right. So that's kind of the answering all this. I just wanted to basically kind of go through this because I think this is a very, very good, right? Right. Yeah, I know. It's just funny. Okay, good. So now that we went ahead and went through all this, that was a lot, right? I mean, this is just a lot of stuff to go through. Now let's go ahead and go through this one here. So let's go ahead and stop the sharing of the screen. Let's go ahead and share this one and make sure it is with audio. Okay. There it is. Are we not expecting earnings to be good? No. I'm not saying that. All I'm saying is last quarter from last year, the quarter of Q3 of 2023 wasn't great. So Wall Street's going to be looking at what this improvement is going to be. I don't know. They always beat, but I don't know, right? Again, I don't like short-term quarter. I don't play Wall Street analyst. I do long-term, right? So short-term, again, you guys can do short-term, right? You're going to give yourself headaches. I mean, imagine all the people that gave themselves headaches, a reverse stock split, all this other bullshit when it was 80 cents. And I was just like, I kept buying, right? I kept buying, and a lot of those folks probably sold, right? And now they're just biting their fingers. Right? And, so yeah, exactly. No, oh, shoot, you just reminded me. Hold on. Share this screen instead. Okay, good. I didn't know I could do that. Okay, so let me go ahead and see. I don't have to. Been doing it wrong this whole time. Okay, so this is Humana. Humana reported today, guys. Look at this. Look at this. This is their benefit. This is their like medical cost ratio, right? They call it the benefit expense ratio. Last quarter it was 86.6%. Guys, you know what this quarter is? 89.9%. Can we round up to 90%? Yeah. Someone asked that. Yeah. Okay. Clover could issue more shares as well. I mean, I don't. They said they're not going to dilute, so I don't know about that. But yeah, they can potentially. I don't know, right? So share this instead. So now let's go ahead and let's do that. Okay. Now let's go ahead and see.
All right. Hopefully you can hear me all right. Welcome back from lunch.
You guys hear that? Do you guys hear that?
Everyone, and happy to have you here joining us for this session, Navigating the Future, Collaborative Strategies for Payers and Providers in Healthcare. I'm Scott Turco from Medallion, and today we're diving into collaboration between payers and providers and understanding why that is not only vital, but key to shaping the future of healthcare. So we'll explore value-based care models, innovation and reimbursement strategies, and how these partnerships are driving meaningful change.
So that was kind of weird. I don't know what happened there. That was weird. So let me see what
going with this discussion. But before we dive in, why don't we start off with something a little fun?
Hold on.
Value-based.
Sorry about that. Let me just kind of that was kind of weird. My bad. My bad. All right. I don't know what happened there. Okay. Let's try this again. Let's see.
Collaboration between payers and providers, and understanding why that is not only vital, but key to shaping the future of healthcare. So we'll explore value-based care models, innovation and reimbursement strategies, and how these partnerships are driving meaningful change. I have with me Travis Dalton from Multiplan and Andrew Toy from Clover Health. I appreciate you joining us today and keeping us going with this discussion. But before we dive in, why don't we start off with something a little fun for the both of you? If you could take a month off to travel anywhere in the world, where would you go and why? So an impromptu sabbatical. Travis, why don't we start with you?
Yeah, happy to. Thanks, Scott. So first of all, thanks for your time. Thanks for your invitation. Appreciate it. Nice to see you, Andrew. Thanks for those that are listening. I appreciate your time. I won't bore you with my life history, other than it does inform my answer slightly. So at Oracle, I covered 32 countries as part of my responsibility, so I had a chance to travel a lot. I also spent 2 years. I taught high school in Japan, believe it or not, in the Japanese Alps. And throughout my travels, ultimately, I made like one of those COVID purchases, and I have an apartment in Barcelona. So my answer is going to be Barcelona. Spain, because I think it's a combination of a lot of great things, close to the beach, but you can also get, great cuisine, nice people, incredible lifestyle, plenty to do, very walkable. Feel like I'm on the chamber for the city. But I would say Spain is probably my spot. So.
I like it. Andrew, how about you?
I remember, great to be here. Thank you. And Travis, likewise to see you. I remember when I went to Barcelona for Mobile World Congress. It was the first time I went. And then I like to eat dinner early, especially when I'm jet lagged. So I tried to eat, you're laughing, right? I tried to eat dinner at like 6, which I think is a very reasonable time for dinner. And I couldn't find a restaurant that was open. I was like they're like, no one eats dinner. Anyway, for me, it's like an interesting, boring answer, perhaps. Like when I had time off like that, I probably would just stay at home. I just like to be not my home office is where I would go for a month and explore other parts of my house. I'll just stay here.
That's a good one.
Yeah, you're breaking up a little bit.
Start by that. Let me I'll try and they could hear me, but let's start by talking about you.
Hey, Scott. This is Lauren from the Medallion team. Hey, everyone. Scott, your audio is breaking up pretty bad. So I'm going to jump in here and possibly ask if you're able to test out audio really quick. And if not, we can't get your audio back then. Travis, Andrew, I'm going to join the party and help moderate today's session.
Great.
Scott, are you back?
I'm here, and if I'm still breaking up, then I can try.
You're good now. That was a good save. I don't know what you did, but I will hop off stage. I'll come back if you need me.
All right. Well, hopefully technology. Yeah. So as I was trying to say, let's start by talking about collaboration. And Andrew, we'll start with you. What do you see as the biggest opportunity for payers and providers to work together in the current healthcare landscape?
Yeah, so obviously, spent a lot of time thinking about this, especially from a Medicare perspective, but in general. I think that the real common basic story that we have here is that in the country, how we navigate healthcare is very, very confusing, right? Extremely confusing. We were talking about a little bit about this before. And I don't mean this in a bad way, but it's just true. Most of the time, I would say that most providers, they themselves do not know how to navigate health insurance. It is a mystery to even people in the healthcare industry. It was certainly a mystery to me before I came in and sort of ran a payer, right? So it's extraordinarily challenging for people to understand all the nuances of how everything is set up. And I would open with saying, it's a great opportunity for us to be able to just share and educate everybody. And rather than just saying, well, what's the allocation of the dollars and how are we going to do this and how are we going to do all the contracts and all those kinds of things, take a step back and say, well, what are we really trying to go for? What are we trying to design? And what are the goals of a given provider group? And what are the goals of the payer? I think it's oversimplified oftentimes when we discuss this to make it about, oh, payers just don't want to pay, which is not true at all. And sometimes providers they want to overbill. That's not true at all either. Some providers are very into value-based care, and that's what they want to do. Some providers have no interest in value-based care and just want to practice medicine and just want to be paid fairly in the most simple way possible. Also fair, right? So I think that we need to break it down and say, well, what are the goals of individual providers? We all want to look after patients. We then have payers have enough programs that we can accommodate all those different ranges of needs.
Great, helpful. And Travis, what do you think?
Yeah, I totally agree with Andrew. I had the opportunity, my first 22 years of my career, I was serving primarily providers and health systems. And here, we do a lot of work across networks, but also with payers and employers directly. Look, I'm going to start philosophically with a mindset. Collaboration comes from the idea that there's a mutual interest. And I actually think there is. And I think it's not talked about that often as it relates to healthcare in general, but particularly when you look at this space and these issues we're discussing. And, to me, providers, what they a lot of times want is care, quality, and appropriate price point. And DSO is going down. They want cash in the door so they can operate. Payers want to manage risk in a fair price point, a value point that makes sense inside of the risk models and the plans. And employers want plans. They want cost to be maintained or go down and prices that are fair for their employees, which all
right, guys, just really quickly here. Hold on for a sec. Just give me a moment. Wow, I've never heard my computer fan turn on. This is the first time. It's a new Mac. Wow, looks like we're working it today. That's kind of weird. Looks like it's getting a little old, getting a little senior. Maybe it needs Medicare Advantage. All right, so just very quickly, just give you kind of my 2 cents to make sure the audio is good here. Okay, good. All right, listen, guys. So we've been 8 minutes into this whole thing, and what have we learned? Nothing. Right. This was not like so far. I don't really see anything valuable. But what I do want to point to is just look at Andrew Toy bobbing his head. He's empathic. His emotional intelligence is that of he's a good CEO. He's a wonderful CEO. I mean, like this guy's being more esoteric and just different, you know what I mean? And I just don't really, I don't, you know, I'm trying to, again, I'm so far I haven't gotten out a lot. This gentleman definitely more, that's why strategic, right? Partnership. This definitely them two need to talk. I don't know. I need to hear more from him, but I'm just saying, as of right now, there really hasn't been that much good talk but just what I can gain, like what I'm trying to say is it's not like these people are bad. I'm just saying that I haven't gained anything that I don't understand. Like I know what so far I haven't learned anything. This gentleman here, Andrew Toy, he is he's emotionally intelligent. I mean, just look at him. He's nodding his head. This is how you develop connections, right? You don't become an asshole, right? This is how you develop connections. This is how this multi-plan. Maybe this guy knows other people and other things that maybe the SaaS still can sign. This is how you form. Listen, guys, I'm on a task force right now to try to end homelessness in Arizona. And guys, listen, it all starts with the connection and the community. And the CEO has it. The CEO has it. Okay. Sometimes it may not benefit him because, unfortunately, sometimes I've been in meetings where I'm just like, this was a complete waste of time, right? But if you ultimately utilize this behavior which he's exhibiting, you get somewhere. Now, just very quickly, just bear with me for a sec. What I want to do right now, because shoot, hold on. What I want to do right now, just real quick, someone posted this on our on Twitter, and I retweeted them. So this is Vivek. Vivek posted this. He said this in his blog. He said that in 10 years, I strongly believe that it is possible for Clover to have made the biggest positive impact in healthcare, while simultaneously accruing the largest market value, aka market cap, in healthcare, in excess of any healthcare company that exists today. That's a huge statement. In fact, let's go ahead, copy it.
In 10 years, I strongly believe that it's possible to make the biggest positive impact in healthcare, while simultaneously accruing the largest.
And let's go ahead and figure out kind of where it is. Where did this come from? Where did this come from? The question is, I need to figure out where this came from here. Yeah. So don't worry, we will find where this came from. I found where it came from. It's from a Median article. We will go up to our stock terminal because we were talking about this yesterday. Just give me one moment. Sorry to stop. Who's the founder, Al or Vivek? That's so funny. Vivek. I'm a nobody. Let's see here. Just kind of give me a second here. It's in here. I just gotta find it. Oh, here it is. Okay, so there it is, right there. Okay, there. Okay, so back. I just wanted to mention this because it's in the cover title, so I want to make sure we get this. So let's do share this tab instead, so that you could see this was written in January 5th, 2023. Okay, so January 5th, 2023. Let's go ahead and we can go ahead and reread this over again. We'll make a video just discussing that, but let's go down to this statement here, statement number 5. Okay, let's go ahead and read this. Okay. In 10 years, I strongly believe that it is possible. First off, let me just highlight it so we can kind of like all read together, because sometimes it's easy. Okay. Oh, I need to sign in. Okay, screw it. Let me just highlight it like this. All right. So in 10 years, I strongly believe that it is possible, okay, for Clover to have made the biggest positive impact in healthcare, while simultaneously accruing the largest market value in healthcare, in excess of any healthcare company that exists today. Holy shit. Right? If this doesn't make you say holy shit, then you don't understand what I'm trying to tell you here, or you don't understand what Vivek is trying to say. Okay. So the journey there, while having already been very volatile over the last 10 years, it certainly has, will only continue to be so. We are in the extremely early innings, ladies and gentlemen. It's 10:25 right now in Arizona time. It's, what is it? 11:12. It is 1:25. It's 1:30 in the morning right now in Eastern Standard Time. I used to be in Eastern Time. I would not be making this video right now. So for all the people who are in the Eastern side, I'm sorry. I'm sorry that, I'm making this video. But listen, guys, for all you up right now, listen, I'm going to say this right now. We are in the extremely early innings of this exciting journey. We are early in the stock. Historically, this should have been a $5 stock. This should have dropped to $5 and it should have stabilized. That's what Chamath got in at 5. This thing should have never gone to book value. It should never have gone to 60 cents. When I saw this, I said I needed to jump on this and I need to put every body, mind, body, spirit, and emotion at 60 cents. Right? I jumped on this like crazy and people didn't believe it. It's okay. It's fine. Right? You can't help anybody. You can't help everybody. We are early. We are early in this game. We are so early. If what Vivek says is true, then we are potentially looking at a $50 to $100 billion market cap. 50 to 100, even Andrew one time said 150 billion. Okay. You understand how much money this is? Do you understand? We were talking about this at a $300 to $400 million evaluation. We're talking multiple X's amounts of billions, and we are early in this game. We are so damn early. We are so early. People don't even understand how early we are. They're going to look at us. People are going to watch these videos and they're going to be freaking slamming their heads on the table. They're going to be slamming their heads on the table thinking, why did YouTube not recommend me this damn video? And I'm going to say, I blame all of you guys for not smashing that like button. Oh, nice transition, right? I'm just kidding. No, but listen, I'm telling you guys, you got to help people out. Hit this video, share this video, whatever you can do, all right? I'm telling you, we are so early in this. Guys, we've seen AI in everything, okay? Except healthcare. You understand how early this is? All right. So let's continue reading. And I'm excited for Andrew to lead us on this next and extremely important phase. When I look across the healthcare CEO landscape and my top 3 list of where value will accrue, it's obvious to me that Andrew is head and shoulders above anyone else out there. Ladies and gentlemen, we have a computer scientist leading a healthcare insurance company. I'm going to repeat this again. We have a healthcare person that's leading. We have a computer scientist leading a healthcare insurance business. I'm going to say it one more time. We have a computer scientist leading a healthcare business. If you don't recall, let me just very quickly, we're going to go back to the video, but I think this is an important thing to say. All right? Important to talk about this. Okay, hold on. One more time. Can I get one more time? Okay, we have a computer freaking scientist leading a healthcare company. Holy shit. Okay, let me explain to you, okay? All right. Vinod Kushla. Did I say his name wrong? No, I said it right. This guy here, Vinod, some of you may know him already. Do you guys know who this guy is? This guy's a goat. He says some weird things out, on Twitter, but it's okay. People can have weird opinions, okay? But this guy's a goat. This guy's a freaking goat. You know what a goat is? I'm going to go buy a goat and send this guy a goat, okay? Someone drop his address in the chat. I'm going to literally get him a goat. This guy was the first investor in OpenAI. He saw the AI phase even before OpenAI was even created. You understand? He wrote a paper back in the day. And let me go ahead and find you this paper. I think he wrote, first off, hold on, before we talk, let's look at his net worth. His net worth is 7.8 billion. It's not accurate. It's like 10, 12 billion right now. His net worth shot up a lot. This is not accurate. He's worth more than this. But even then, he's a billionaire regardless. Okay. So back in 2013, and most people will never tell you this because, this is life. This is life. Let me see. Medicine, then the biological science. Okay, hold on. There it is. Oh my God, I'm salivating. Are you ready for this? Are you ready for this? Listen, unfortunately, there's a lot of people in this life that keep this information to themselves, not us. Okay. When was this written? Somebody on the chat, drop it in the chat. When was this written? What year was this written? Someone drop it in the damn chat. I'm not gonna go on until I see the number. Someone drop it in the chat. I'm gonna just wait. Okay. I'm just gonna wait. Okay. What year is this? What year? Drop it in the chat as I get something else up. Someone said 11 years ago, 2013. There it is. Good. Good. Let me pull this up real quick. I was hoping you guys take a little longer so I can pull this damn video up. Al's Movies. Where is it? Oh, here it is. All right. This was an interview from Steve Jobs back in 1981. I posted it yet last night. Yeah, I'm up at nighttime. At nighttime, I don't like to watch bullshit. I don't like to waste my time. Okay. I like to watch interviews of billionaires before our time and how they saw the world and how accurate they were. Like they're the oracles. Okay. Yeah, that's a great interview from Steve Jobs. All right, now let's go back. You guys are correct. 2013, 11 years ago. Good. Okay, let's go ahead and read what he had to say. Title, Vinod Kushla. In the next 10 years, data science will do more for medicine than all biological sciences combined. So let's go ahead and read this again. In his beliefs, right? In the next 10 years, data science and software will do more for medicine than all of the biological sciences together. Now, that's a pretty controversial statement, but Kushla believes that mobile tech and cheap hardware could seriously change the healthcare business within just a few years. We can go ahead and continue. 11 years ago, this guy predicted. I wish I read this in 2013. I did not know, okay? Because I'm in the biological sciences. I'm about to get replaced. You understand what I'm saying? I'm about to get knocked out, okay? I'm about to get boom, right? I'm about to get knocked out, all right? I'm telling you right now. And so then now, let me just repeat. This was 11 years ago. This guy said in the next 10 years, data science will do more for medicine than all of the biological science out there combined. And then we go to this statement. We go to this statement. Let's find it. When I look across the healthcare CEO landscape and my top 3 list of where value will accrue, it's obvious to me that Andrew is head and shoulders above anyone else out there. In 10 years, data science will do more for medicine than all biological sciences combined. Who the hell is Andrew? He is a data scientist. He is a computer scientist. And what did Vivek say? In 10 years, I strongly believe that it is possible for Clover to have made the biggest positive impact in healthcare. What did Vivek say? In the next 10 years, data science will do more for medicine than all biological sciences combined. Who is Andrew Torrey? He's a computer scientist. Okay. What does Vivek think? while simultaneously accruing the largest market value in healthcare in excess of any healthcare company that exists today. Are you seeing what I'm trying to say? We have an internet communication device and a phone device and and an iPod, an internet communication device, a phone device, and an iPod. I've listened to that's Steve Jobs, if you don't recall. I've listened to the billionaires of our time. I've listened to the top, smartest people in the world. I'm telling you right now, what Andrew is hitting on right now, if it is deemed successful, the people that are watching this, all 92 of you, we got 36 from X, Twitter, and we got 56 from YouTube. If this thing right now, that are watching live, right? This thing hits, and this right now, it's 10:35 p.m. in Arizona, right? It's 1:35 a.m. in Eastern Standard Time, and God knows what time it is in different parts of the world. People are tuning in. Our lives is about to completely change once this comes true. You understand what I'm telling you? You understand? You know, a lot of folks are. I don't know if we'll get there, but I'm sure going to make it damn close that we're going to get near there. Okay, which is why when I tell you this is the most undervalued thing that you on the internet that exists right now. We're going to make so many people multimillionaires. Okay, this is the most undervalued thing you'll ever find on the internet. That'll take you from zero to hero. Right? You will not find a stock like this. If this thing executes, this thing has the power to disrupt healthcare as we know it. Okay? All right, so that's my spiel. Hopefully it makes sense. Let's go back to the video and we'll go from here, right? The guy eating goats. I love lamb. Oh, I love lamb too. I might get one for myself. Just kidding. Yeah, Toy makes his money. Just one more time. Wish I could sell my boat to buy more clove. I just need to have a boat first. That's a good one. I sold all my real estate next time if it goes back down to 2. Oh, you know what's funny? You're not the only person who's thinking like that. How much better do we think earnings will be? Yeah, we'll see. Again, it's hard to do the short term. Okay, yeah, shit is crazy. Yeah, this is crazy. This is crazy. Okay. All right, let's go ahead and let's stop the sharing of the screen so we can share the audio version of this, okay? And we'll go ahead and we'll watch the rest of this, okay? I just wanted to point this out. This is a very important section. All right, let's play.
Ultimately, it's all of us. And so to me, the collaboration point is the intersection of those three things. And that's kind of where we're trying to focus is transparency, cost, and quality, and find solutions inside of that kind of triangle that makes a lot of sense across what I think is a mutual interest. And we'll talk more about it as we go, but I have a firm belief that technology, this is the time for technology. We'll talk a little bit about digitization, the digital record, and what that means for platform-based technologies. But I think you got to start with the idea that we can all seek the mutual interest, which is ultimately inside of that kind of triangle of value that I talked about before you even get to the idea of collaborating on solutions. And so, Andrew, I think you're absolutely on it, and I agree with your assessment. And I hear that every single day. You hear about the vitriol in the headlines, but what I see every day is people really trying hard to solve problems and get it done. And a lot of good things do happen inside that dynamic already, but there's a lot to do, as you guys know.
Yeah, certainly. So ultimately more commonalities than anything, and being able to understand that. We'll talk certainly much more about technology and data and being able to understand those things in a little bit. But I'll pick on two items that you had mentioned, Travis, in terms of keeping costs under control and patient outcomes. But when it comes to value-based care models, how do payers and providers work in tandem to improve those outcomes, but also keeping the costs under control? I don't know that there's any particular secret sauce there, but interested in exploring that particular aspect of outcomes versus cost control.
Yeah, I'm happy to jump in, and he's probably got more expertise across this in a lot of ways. So I'll say a couple of things. And I agree with the person that just said credentialing is important. I think it's super important. We're not a payer, we're a technology provider at Multiplan. And so, we provide networks, we provide cost containment solutions. We also provide data science capabilities. I think part of the value-based care discussion is persistence and commitment to it. I mean, 10 years ago, 15 years ago was the first time, I started to think about this as it relates to some of the health systems I work with. And it's a long journey, but I think it's the right one to be on. And so for me, there's building blocks to that are really critical. And, I think it starts with transparency, and it starts with data, and it starts with information. And then this idea that you can interoperate, you can have open API-based collaboration between partners like us and Andrew, and then ultimately looking at risk and thinking about capitation and models inside of value-based care are all important. So those are some of the tools that I think are necessary. And I'm really a very big proponent of it. And part of the company strategy for us going forward is not to get too technical about it, but it's really to create a data architecture that allows us to be malleable enough to support those that have the objectives related to value-based care, which is capitation and risk management, and tools around that so that you can get maximum reimbursement and best quality. And so that would be kind of where I would start. I'm sure Andrew could expand on that.
I think it was a great answer. So let me jump on and combine two parts of my background, because I come from a bit of a technology background as well, so I can speak to there, and I'll speak payer as well a little bit. I'm gonna go back and forth. I see. Let's start with where there's a disconnect. First of all, disconnect number one: most people cannot define what value-based care is in a way where if you put 4 people in a room, they will say any two of them will say the same thing. That's already the first thing I said when we started this call is like, we got to agree what we're talking about first. And none of those are wrong, but if we're talking about different things, how's it going to line up? Okay, what do I mean?
Okay, yeah. So this is something that I can agree to really quickly. So again, so let me just give you my background. I have 3 undergraduate degrees. One is a BSHS in physiology. The other one is a BA in sociology with an emphasis on medical sociology, which is it's like the public health realm, social determinants of health and whatnot, right? I have a bachelor's of science in neuroscience and cognitive science, emphasizing in neurobiology, and I have an almost completed. I just need to defend my thesis, a master's in science in cellular molecular medicine, and I'm going to be getting my medical doctorate degree as an MD. Okay, so here's and I've been in rooms, I've been in developments of medical respites. I've been on boards of many boards in trying to push Arizona forward. Okay, so Andrew hit it on its head. You go ask people what is value-based care. If I right now go to U of A, University of Arizona, if I were to ask this question, I'm going to get a different response. Maybe like 2 of them are different, but they kind of hit the same thing. Nobody is on this. Nobody is basically. There's not one clear definition, and nobody is like on this. Like they're not in the same team here. Okay, they're like different aspects of it, but they all come together and say, yeah, that's right. Agree. The problem is there's no line of code that says this is what value-based care is. Okay. And there's not a way for these academicians, the people that are in the public health saying, oh, the haves and have-nots of society, the public health folks regarding the social determinants of health, doing all these types of, what do they call them? These, the fish plots, and trying to figure out, what the issue is. At the end of the day, they always are. Their conclusion always comes down to this. They always say it's a complex key of problems where you get social determinants of health is just a complex issue. We have so many different things we have to fix, but the problem is, I know it's complex, right? I know it's complex, but they're not giving me solutions. Remember, I hit up public health folks. I've hit up all these folks, and especially sociologists. Sociologists offer no solutions whatsoever. They just say there's a problem and we got to fix it, right? And public health tries to fix the problem. And here's the thing: has public health done a good job? Oh, hell yeah, they've fixed a lot of issues like, cancer, epidemiology, with the whole water cleaning and all that other stuff, vaccinations. Yeah, they've done a great job. But this is a very complex issue regarding social determinants of health, because you start getting into socioeconomic status, you start getting into social stratifications of class, race, and gender. You get so many of these complex things, but then all of a sudden you get this brain freeze, almost like a cat eating ice cream, where it goes like, you know what I mean? Have you ever seen a cat eating ice cream before? You should watch a YouTube video on that. It's really cute. Okay, so they kind of freeze up, and they don't. It's a complex issue, and they stop there, right? And some want to go forward. What Andrew has designed and what he's trying to get at is he's trying to create a line of code in the Clover Assistant that can solve and eradicate the social determinants of health, one disease at a time. Okay. A lot of these people don't have a coding experience that are in healthcare. And I raise my hand. I don't have a great coding experience, right? But yet again, we have a nice software that we created that helps people go from 0 to hero. But again, it's not as complex as what this Clover Assistant is, right? This is a very strong tool, right? And what we're starting to see is not only does it help decrease MCR by over 1,000 basis points, right? Even more, like 15 to 2,000 basis points, but they advertise 1,000 basis points, right? It's always good to underdeliver and over, than overpromise, right? But he's actually creating a definition, and he's basically leading that way, which is going to be the most impactful thing that he's going to be able to do as a computer scientist leading healthcare. Okay, so that's kind of just giving you my experience in this. Which is why I don't really talk to those people anymore. Right, I don't really involve myself in the public health sphere anymore because I just don't think their solutions are working. Right, and if we do the same things over again, expecting a different result, then that's a clear definition of insanity. Right, so I just kind of gave up on that. I'm like, I'm just going to go ahead and I'll find another way, and this could be it right here. This could be it. Right, and obviously I'm biased because I'm an investor of this movement, and this is going to be good. Right, Clover Health is to healthcare like Salesforce was to tech in 2000. Yeah, I mean, you could look at it that way. Right, so let's go ahead and continue. But that's kind of like my little bit of people have different definitions. No one's on the same field, and I'm telling you right now, rule number one of solving a problem is everyone needs to be in the same field, paddling in unison. You go talk to all the faculty members at University of Arizona and Harvard and whatnot, they'll all say what different definitions are to value-based care. Everyone has their own. But when you have some guy at the helm that has a line of code that can say, this is what could it be, and I have proof that it actually helps, and this is my proof. Better A1C control, right? Better GFR control, right? Better medication adherence. These are the 3 papers that they published. Let's continue.
Value-based care is the opposite of fee-for-service. That's the best way to define it. Fee-for-service is very easy to define. That means you do something or you spend a certain amount of time on something and I pay you for your time or I pay you for the action. That's fee-for-service. Value-based care is I pay you for an outcome, right? Those are the 2 different kinds of programs. Let's be very real. The reason why value-based care is hard, because you're like, why wouldn't you want to pay for outcomes, right? Isn't that what we all want to pay for? Like, yeah, you do. Have you ever thought of going to a lawyer, right? And saying the vast majority of lawyers, if you go to them and say, I will only pay you if I win, there's only a very small number of lawyers who will accept that. What do lawyers do? They bill by the hour. Lawyers are not value-based care, value-based outcomes. They are fee-for-service. That is their entire industry. That is what their industry is built upon, and there's nothing wrong with that. Healthcare is similar. Fee-for-service is inherent to healthcare, and that is what people think about, and that is inherently built into the structure of how providers think. There's nothing wrong with that. Value-based care is the new way of thinking about it. Okay, why is it so much more critical, though, in healthcare than it is elsewhere? This is the reason why it's the most critical, is because in healthcare, if we don't actually pay for outcomes, we are just going to bankrupt the country. Right? No matter what you think about lawyers, it's hopefully not quite possible for the legal industry to bankrupt the entire country. It is possible for the healthcare industry to bankrupt the entire country, and that's not good. So we need a way to bring down costs. Fee-for-service is definitionally not a way you can do that. And so what we need is a way to have a common language where we can say, well, how do we get what we want out of the healthcare industry, whereby we pay for just the outcomes we want and not just for utilization. And I think that is the disconnect that tends to be in place, is that cultural disconnect from the past where fee-for-service was inherent to everything that was done.
And what are the outcomes they want? Better A1C control, better GFR rates, right? Medication adherence. These are all lines of codes that Clover has generated in their Clover Assistant and now Counterpart. Those are the outcomes, and they're able to do it because they have the code and they define what value-based care is. There it is.
Where we need to go in the future for healthcare economics so that we can control total cost of care. So I think that's kind of where we're landing.
That makes sense. And so in finding that. Yeah. And finding that common language, though, obviously very difficult, very mysterious. And so pivoting more along the lines to bridge that gap is data and technology in terms of the role in building stronger payer-provider partnerships.
There it is. How do we bridge that gap? Data and technology. And what does Clover do? Who's the CEO? He's a computer scientist. And what did the note say? In 10 years, data scientist is going to offer more to medicine than all of the biological sciences combined. Let's continue.
How do you leverage the tools to enhance care and streamline the process? But as you say, Andrew, to really find that common language, so we're working towards the common goal of bringing those costs down. Can you expand upon the data and technology element?
Yeah, so 2 different dimensions, because I'm going to stay on the payer side and then I'll switch into a tech way of thinking in a second. But let me bridge the 2 by saying, this is what I do when I talk to tech companies who are in the space. When I talk about, they're like, Andrew, I want to go into value-based care. I'm like, why do you want to go into value-based care? If they're really being honest, they'll say, well, my VCs kind of want me to go into value. So like they keep telling me we should go head in that direction. I'm like, fantastic. So you'll just put all your fees at risk and you'll just only get paid if you succeed. And they're like, no, I don't like that. I'm like, well, why don't you like that? My entire company is valued on ARR. What's ARR? ARR is annualized recurring revenue. All of the tech companies are valued on ARR now if you're a SaaS company, right? You're going to be based on ARR.
All right, let's stop. Very important. He's talking about ARR. When you start utilizing these terms, we're talking about SaaS. If you don't recall, Chamath and David Sachs, the king of SaaS, they're talking about these metrics. These are metrics on how do you evaluate a SaaS company. Do you see how they're talking right now? You see how Andrew Toy is talking? He's talking as a technologist now. Now we've entered the phase of Clover Health, now not looked at in the evaluation from a price to sales of 0.5 to 1 to an actual potentially 5 to 15 or even 20. If you look at Palantir, even higher. Okay, so now we're starting to get into the discussions of SaaS. Okay, so this is very good, right? And obviously this guy knows what he's talking about. Okay, he's done his homework, right? All right, let's continue.
Do you want to put your ARR at risk? No, you don't. You generally will not put your ARR at risk because you've been valued on your ARR. And part of the multiple assigned to ARR is because it is predictable, right? Value is the opposite of
You see, part of the multiple that's assigned to ARR is because it is predictable, right? That's why we can put a higher value.
that. It is not predictable. You can access more dollars, but it is not predictable. And because it is not predictable, it has a very difficult modeling exercise when you back into valuations. So when you look at that, when you have a tech approach from the industry, which is based on ARR, it is automatically anathema to a movement towards value-based care. I'm not blaming anyone. I'm just simply saying you can't have it both ways. And people have definitely wanted both ways. When people have come to me as a payer and said, I want value, I will tell you what they actually mean. I want you to pay me my PMPM recurring fee, and I want a bonus if I succeed. That is not value-based care. That is just fee for service with a bonus on top of it. Value is actually putting your being paid for your outcome, not being paid extra if you want an outcome. And I don't think that's how technology necessarily thinks about it because they're so protective of the ARR. I'm not pointing to any product solution here. I'm just talking to the business model.
Mm-hmm.
Yeah, I see the difficulty certainly in terms of business models coming in the fold and driven by ultimately revenue as the core motivation can ultimately distract from what is what we're saying is the common goal. And so business models intruding on the common goal and ultimately creating a distraction for that. But there's also a lot of ways we've seen a lot of innovation over the years. And I think we can say it a bunch that data is certainly the new oil, right? And that's very true within the healthcare market to be able to understand.
What did he say? What did he say right now? What the hell did he say? He said data is the new oil. We've talked about this before. I said that 2-3 years ago. Kevin from Shark Tank, even though I don't really agree with a lot of things he said, even he said it. Data is the new oil. What does Palantir deal with? Data. What is NVIDIA? We told NVIDIA not to sell chips to China so they don't invade Taiwan, right? It's because it's data. Data. Data is the new oil. What did I say about Clover Health using their 80,000 patients and converting them to literally 100 million data points? Data. Data is the new oil, ladies and gentlemen. And Clover has the data. And that data is what's going to basically separate them from all the other incumbents, because all these other incumbents have been having different silos and basically offering sick care, and they're all about to get disrupted. They're all about to just literally go belly up if they don't advance. Okay, if they don't advance. Let's continue.
These things, not just from a business model standpoint, but also how we evolve. Just in general to leverage tools to enhance the care model and streamline the processes. With that all stated, I'm interested, Travis, on your side of things in terms of data and technology being infused more and more, ultimately in this very complex world that we've discussed at length in terms of really understanding the mystery and pulling back the curtain on what exactly is happening here within healthcare. But I'm interested in your thoughts.
Yeah, it's a big mystery right now, but I'm telling you, if data is truly the next oil, and if Vinod said that in the next 10 years, back in 2013, he said this, in the next 10 years, data scientists will do more for medicine than all biological scientists combined. And if we know that Andrew Toy sits at the helm of Clover, that essentially, he's a computer scientist himself. And if we look at the previous founder and CEO saying in the next 10 years, I strongly believe that it is possible for Clover to have made the biggest positive impact in healthcare. And what is 10 years from Vivek's standpoint? That is 2033. 2033 is in the next 10 years. And in the next 5 years, we're going to start seeing mega proof of concept. Now, this year we saw proof of concept, which is why we're up approximately 542%. This is the proof of concept, but this is not the mega proof of concept. We haven't seen that yet. Right? Let's continue with this talk. Let's continue. Okay? Let's go ahead and continue.
Thoughts on data and technology. I know very broad category to expound upon, but interested in what you think here in terms of enhancing and streamlining processes with data and tech.
Yeah, I mean, a couple things. So, we're back to the prior question. I would say it's an interesting one in terms of value. Aside from value-based care, technology as an industry, there's a lot of point solutions. There's a lot of confusion out in the market, and I think there's also this idea that scale advantage and holistic solutions that are well connected can bring costs down in healthcare. And so, to the broader discussion around, what do I think about technology in healthcare? I mean, I think that the market demands have never been higher. I mean, what do consumers expect? They expect a less opaque process. They want transparency. They want information at their fingertips. They have AI available. They're their own care management team. And the regulatory environment has never been higher in many ways. And the pressures have never been more when you look at inflation, you look at workforce shortages, labor, and other dynamics. And so I think, for us, what we're trying to do is look at that and determine, what my prior company, our CEOs say all the time. This was a decade, 20 years ago. The most dangerous thing in healthcare is a pen. I can't see that because it's blue. There's a pen in my hand. And that was true, but that was a decade of digitization. The next decade was the decade of, kind of data. We have some data. I think it needs to be the time of insights. And insights are different than data. So it's taking things and making them useful and relevant on a provider world inside of an actual workflow, so an intervention can happen. In our world, it's useful as it relates to transparency, as it relates to cost containment in healthcare. And it relates to this idea of automating quality processes so you can get maximum reimbursement associated with that. And so I just feel like it's an interesting time, and common goal was two words that were said quite a bit. If we can align on common goals, I think we can collaborate on solutions to help solve those, which is why I like talking to Andrew and his company, because they're very interesting to me and what they do. And I think we can work together on networks and risk. And I think that could be pretty interesting.
Yeah, I'll just build on that. I think that
So let's just pause for a sec here. So, a lot of people now are starting to realize this whole data, oil, and all those things that basically we've been talking about is the thing. And he just basically, Travis Dalton just said that, he wants to go ahead and work with Andrew in that regards. I don't know who this guy is. So let's just kind of just pause the video for a sec and let's try to figure out who this gentleman is. So let's just kind of, share this tab instead, and let's kind of figure out kind of who this guy is. Kind of let's do a little bit of, who this person is. So let's kind of dox this guy a little bit. Or what is doxing? I don't know. I like stock or whatever you want to call it, right? Let's see. So with over 20, or just do your, just a little more professional, let's do our normal research. Okay. So with over 20 years of leadership experience, focus on enabling outcomes from social. So what does he lead? What does he do? So he's, what is multi-plan? What does that mean? What is that? See, so clients around 32 countries. So that's important. That's weird. So this is not just domestic, it's international. General manager at Oracle. Yeah. Okay. 8 months. Chief client and service officer, president in Cerner Government Services. This is very interesting. 21 years in Oracle, Cerner. That's a big deal. Good. We'll talk about what this means. Okay. All right. So what is multi-plan? So now we know that. So what is multi-plan? Let's figure this out. Shining a light on patient healthcare experience. Okay. With ongoing expansion and enhancement of products, we have never been better positioned to increase value we deliver to more than 60 million customers, 1.4 million contracted providers. Holy shit. Look at that. This is it. And who's this guy? This guy is the president and CEO of this company. This is huge, guys. This is it. This could be the next partnership. Right? So they have 60 million consumers, 1.4 million providers, 100,000 employers, 700 customers. So this could be another gateway for Clover Health to get their counterpart assistant to essentially to the next level. So this could be it. I mean, again, I don't know, but payers, providers, yeah, it seems like it, right? Payers. See here. So this could be it. Yeah, this is good. He's competition isn't. I'm not too sure. Yeah, so they want to work together, right? This is good. All right. I'm just curious. I just want to know who this guy is, right? All right, let's share this one now. Yeah, let's go ahead and let's work. Let's go back.
Definitely agree that as we look at this, definitely time for insights. And the key thing is, and Travis, I think you said it really well, is data insights are not the same thing. And people are often heavily conflating those two things in the industry right now. And that causes problems, because if you go to providers, if you go to clinicians and you just give them a ton of data, that's actually not helpful, right? Giving them a lot of insights, they do find helpful as long as you're speaking in their language. But giving them a ton of data just seems like you're giving them more homework.
You see he's writing it down because this is experience from Andrew Toy that he's seen. Giving them more data doesn't help. You got to give them data that they need, actionable insights to augment the physician, to enable and to empower the physician.
To do. You're like, now you need to sift through all this data and try and figure out what you're going to do with it. Not helpful. And that would come down to what a lot of other payers do, is like give these chase lists or give these, like, all those things. I do not believe that naturally connects to a clinician's mind as to them saying, this is what I have to do for good medicine, versus this is what I have to do because someone is making me do it, right? Which seems like busy work. So I think that technology in the next era is very much the requirement, is to make it much more intuitive to use. Kind of like Travis, like you were saying, like everyone's got tech in their personal life. We know how to do this in people's personal lives. Mm-hmm. It's just bringing it to the work environment, and especially to when payers and providers hand off those insights to each other, it tends to become a little corrupted in the process.
Yeah, I think that's a great point. And Travis, I think you hit it right on. When I was explaining like the focus on data, I think the way you had articulated it was really transitioning from this mode of data-driven care into insights-driven care, and how do we actually leverage that? So as Andrew noted, not being overwhelmed with data, but providing true insights to move the needle in terms of cost, but in terms.
And that's exactly what Andrew Toy's providing. They're providing insights, and these insights they're just going to get better and better as technology gets better. And guess what? They are ahead of the game because they have the data, and data is the new oil. Okay.
Of outcomes as well. Again, just tying once again to those common goals that all entities have in terms of treating a patient. So that makes sense. And thanks for.
And just one more thing. Clover Health is not an insurance company. It is a data insurance company. It is a data company. Clover Health is a tech-enabled insurance company. It is a tech company. Clover Health is tech. Okay. We already have the data, right? Tech. Clover Health is a tech company. It is a tech company. And most people on Wall Street are going to figure that out, right? And once we do, it's going to be very good.
Help us understand that a little bit. If we can get into some maybe specific examples that you've seen in your line of work on payer-provider partnerships that have led to significant improvements overall in terms of quality of care and cost savings. Are there some specific examples that you've seen implemented that have actually worked out in recent days, and not looking so far in the future, but really happening today? We'd love to talk through some of those examples of it's not all doom and gloom as we see it today. There's real things that are actually happening today to move that needle forward. Travis,
yeah.
let me you on that.
Yeah, happy to mention a few. For you're talking about examples. I guess one of the things I would say, anytime you look at a problem, and again, I hate to be a broken record, but I try to keep our company focused. I mean, the expanse of this conversation, we could spend multiple days talking about multiple examples across healthcare. I mean, it's very expansive, it's highly complicated. But as we look at, cost, transparency, and quality, those are our focus areas.
See, he just pretty much said he said we could talk about this a lot. I like to keep my company focused. This thing is very complicated. It's just a complicated thing. Well, guess what? Andrew Toy is the only one in the healthcare space that is trying to uncomplicate this through code. You see what Travis just said. All the BS that I've listened to all the folks that from the masters in public health, from the sociology, from all these people, they just, it's very complicated. It's a set of issues, yada yada yada. Well, this guy here, right? He's solving it. Andrew Toy solving it, right? He's uncomplicating it through data scientists. None of these people here are data scientists. He's a data scientist. Okay.
I try to think of things as, it's funny. So I tell my team, if you're going to solve a problem, and this is not to name drop, but I spent a few minutes at Oracle, and this is what Larry always says: solve the whole problem, right? And so as I think about bringing solutions to the market, think about drawing the anaconda, which surrounds the problem from all angles and constricts that and solves it. And I mean that it's not just one thing. So when we look at quality or cost, the way we're thinking about it is on three dimensions. One is you've got a set of, a healthy network that has a network of providers that are, one, expansive and complementary, but also can be tailored in a way that makes a lot of sense, is a good thing. So we do work in that area, and those networks in many ways perform, and many of the large payers and others provide networks, and I think networks over time make sense. Data science is something that is really critical. So the idea that you can look at a problem, that you can actually predict risk, or you can look at high risk populations, and specifically for us, MSK is one that we've looked at, and you can go and you can actually predict who might need NIP or knee, hip, other replacements over time, and you can create early interventions off of that ultimately reduce costs but improve.
That's exactly what Andrew is doing. Andrew is ahead of you, Travis. You need his software. Okay, you can go ahead and try doing it on your own and look at your little. Andrew's already doing it. He's been doing this. What you're doing, they did in 2018 and 2019. Okay, it's about to be 2025 now. Okay.
The health and wellness of a population that an employer might serve or that a health system might serve. Those are real things happening today. I also think on a practical level, from our perspective, I believe that we can move what we do on the payer side of the world more to the center of healthcare, which is how I would really like to position the company. There's no reason, in my view, that our capability and technologies couldn't be used at a clearinghouse level or actually.
See, our capabilities and our technologies. Whose technologies? The counterpart assistant technology. Whose technology is that? Clover Health. We own that technology because we are the shareholders. Okay. He has, you see how Andrew Toy set this up? He needs our software. But the beautiful part is we don't charge him yet. We do a shares revenue savings plan. So if we incorporate our software in his company, then that's going to be great because then it's a shares shared. So we all benefit, right? You see how that works? He needs us. Okay.
To the left of healthcare, working directly with providers to accurately and properly price products and services in a way that takes down denial management needs, that results in cleaner claims over time. And so I think that technology players should look at themselves as transparency players and platform capabilities over time. And thinking about it holistically, to me, is the right way to do that. And then it ultimately connects to other areas of healthcare like care navigation, value-based care work, which we've talked about, but also steering to quality. If you have those good insights, if you know what your network looks like, if you're actively engaged, you can steer into a higher quality environment at a lower cost. And those are some, I've used those are a lot of topics there, but those are some examples, Scott, based on some of the things that I'm seeing and that we're working on. And some we're not involved in at all. I just think they're important for healthcare.
Yeah, that's great. And Andrew, what do you think?
Yeah, I have a couple really resonated with what Travis just said. One of the ones there was site of service management. Definitely a huge one, right? Like I love the predictive side of things, and that's where I spend most of my time as well. But like, there's what I would like to focus on is a few of the examples that Travis gave there. There are just some very
okay. Just let me just really quickly, I'm just gonna just restart this for a little bit here, and I'm just gonna go ahead and show you. So this company, the CEO in Multiplan. This is his company. Shout out to Jeff Ho for showing the stock symbol. This company right now, year to date, is actually down 83%. The stock went down from $43 to like it's been falling, right? The stock's been falling. Okay, so the stock's not doing well. It's $151 million market cap, so it's a small market cap. There's a lawsuit filed alleging price fixation by Multiplan. There's a lot of issues in surrounding this, and this company I'm not too sure. Could it die? I don't know, but they're down. This company is okay. You know what? Let's do our research. Okay, let's pull up our stock terminal. Okay, let's just pause for a sec. Okay, let me just pause for a sec. Okay. I just posted this during our live. Okay, let's just kind of go ahead and let's just kind of do this real quickly because I think those will be very good, kind of doing it together in real time here. Okay, ladies and gentlemen. And then we go to let's open up the help menu. Our platform is very fast. Just a few clicks of a button, you get to know what's inside of a company. Okay, let me just delete out this. Like that, and within seconds we'll be able to get this guy's data. So we have the data here, we download the data, we open up the data, and the data should open up in an Excel spreadsheet. All right, there it is. All right, let's just basically figure out kind of where we are here. Okay, so overall we look at revenue. I'm just curious to see kind of what revenue's been looking at. So they make on average about $233 million in Q2. They made around $234 million in Q1. Last year, let's kind of just they made around, so it's around 230. Let's just make it 230. So we could say 230. Obviously, it's more than that, but 230 multiplied by 4. So they're about 920 million to $1 billion in revenue. Okay, that's the company. The problem is, just look at its net income. They are burning cash. I mean, they're just freaking burning $500 million in cash. Like, this is just a cash burning business. Okay, so let's look at its free cash flow, because that's ultimately where I care about. So let's look at its free cash flow real quick here. Obviously, net income is important, so they're burning cash here. But let's just kind of see where we're at here real quick. So yeah, they got some here, and then they're so about that -6 million, positive 19. Okay, so they're getting there. Okay, so that's interesting. So I need to look deeper into the company. Let's look at its cash right now here. So they got around cash and cash equivalents around, shoot, $59 million, which is why, I mean, these people burning cash. Let's look at the total assets right now. Total assets. I got to figure out what this company, total assets. They got a lot of assets. Holy mo, look at those assets. Think about 5 billion. Let's look at its total liabilities, 5 billion. So yeah, there's a lot going on in this company. So, this company, it looks like, let's look at the stockholders' equity. This thing, let's look at the stockholders' equity right now. Let's see how it's changed over time. So stockholders' equity went from $1 billion down to 603 million. So the stockholders' equity has been going down. I mean, it went from 2.4 billion down to 603 billion. So this thing's basically done. It's pretty much dying. The question is, when are they going to basically stop burning cash? So that's kind of the ultimate goal here. Is, when are they going to stop burning cash? Let's just really quickly, go to MPLN real quick, and let's just kind of figure this out. And here's Travis Dalton. Here's the CEO of the company. That's the guy that's speaking, right? Travis Dalton. He's the one that's speaking. He's this guy here. So his company, I'm honestly curious to kind of see, let's we can look up the news real quick, but we can do a couple things. We can go to FinViz. We can just open up this one here, Multiplan. Let's just try to see kind of the news. I like to look at the news real quick here. Drive strategic growth, appoints this guy, announces announces executive leadership change. Lots of things are happening right now because this company is pretty much dying. I mean, look at all the, this company is dying pretty much. Reverse stock split becomes effective because they're dying, and I'm sure the shareholders are upset probably. You see, scam company, they hear shitty SPAC scam, blah, 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 blah. So people are very upset here, right? So this company is looking for help pretty much because this company looks like it's not doing well. I mean, based off of what I'm seeing here, right? And here there are points, they're trying to drive strategic growth. So they appoint Tiffany. I don't know who the hell Tiffany is. Again, she's a chief growth officer. I don't know who Tiffany is. So let's just see who she is. And, she's from Pennsylvania. Oh, we have some mutual connections. Okay. So we got some mutual connections. Interesting. Okay. So why is she growth? She's only been here for a month. What did she do? Okay. So she's more sales, vice president. So she has some experience. I don't know. Okay, I don't know. So let's see. Let me go back to. Let me see what's going on here. So leadership change, all these different things they get. They did a reverse stock split, announced a CFO transition. They got a new CFO. I mean, this company's trying to basically survive right now, right? Because, and again, how did I know this? I looked at their financials. I see that they were dying, right? So I got to figure out why. Their gross profit seems to be good. The problem is I need to do more research, right? The problem is what's going on? That's one. We need to go a little deeper, right? Of kind of what's going on with this, right? But overall, they need help, right? They really need help. There's a lot of things going on. So right now, Andrew Toy is in a position of power. Travis needs Andrew Toy software, right? If they're truly losing cash right now, this guy is burning cash right now. If you look at him, he's burning cash right now, right? He's burning a lot of cash, and he may need the counterpart assistant, right? Right. No, but the thing is, I don't know where the 700 customers come from, but they have $5 billion of assets, and they have about $1 billion in revenue. So I about around $1 billion. So if you look at them, they work with more than 1.5 million providers, and those providers deal with other things too. So there's a lot. It's not going to hurt us, right? We're just going to give them our software, and if they save money, we make money. So, or we have them pay for the software. So this is a strategic partnership. They need Clover. They need us, right? But again, let me just really quickly go to multi-plan.
Multi-plan.
Just real quickly here, guys. Let me just go to multi-plan so we can kind of get to this, right? So just very quickly, they have 1.4 million contracted providers. 1.4 million people, they could be using the Clover Assistant, right? So that's what I'm saying, right? Right. Each of those exactly have customers, right? So there's a lot of good stuff, right? I don't know who these customers are, to be honest, because so this company looks like it's dying. There's a lot of downgrades happening here, $2, $6.50. So there's that. But really quickly, I want to do right now is just kind of copy the ticker symbol real quick. And let's just kind of open up the stock terminal real quickly here, and let's open up the terminal here, and let's just kind of do some stuff here. Let's open up the Wall Street command, and let's kind of put the terminal here, and then let's look at the price target consensus, and let's look at kind of what Wall Street thinks. Yeah, there's not really a lot of consensus here. Okay, so book value has gone down to 93 cents. So it's literally gone down. They've gotten some debt. They're about a current ratio of 1, so it can be livable. They're in survival mode now. Price of sales, it's gone down. Shares, they diluted shareholders from 2018. Just look at the shares, right? Operational cash flow, interesting. It's positive. Am I seeing this correctly? It's positive. Free cash flow. Am I smoking? Where's the net income here? Give me the net income. Net income is negative $1 billion. You see, this is where it's dangerous. We have to figure out why is it negative $1 billion. And if they can fix themselves, then yes, they could have a future. But we got to figure out why. And the thing is, it's unprofitable. Why? Because the expenses are tough. Why? Because potentially maybe they need the Clover Assistant. And if the Clover Assistant can help them, then potentially they may not stop burning cash, which may bring them back to heydays. So, So again, when I look at a meeting, I always like to look at what is this guy's incentive. This guy needs Andrew Toy. It's written all over the wall. Okay. So there it is. So I hope, again, you see what we did right now within just seconds of me just flailing around with the stock terminal. We got access to data, and we took this data and we went back all the way back to 2019, right? With this data here, 2019. And we not only we got the income statement, balance sheet, and we got the statement of cash flows. We got all this data. And why? This data helps us because then it's able to basically, we understand what's in the mind of this gentleman. Okay. All right. So I hope this makes sense. Let's continue sharing the screen now for the audio, but I hope that you can see the power of our, overall stock terminal and lifetime access bundles. It will expire this Sunday, so take advantage. Main Street gives you $600 off lifetime access, and you can use Affirm for Canadian and United States customers. Okay, all right, folks, let's go ahead and continue on.
Said one of the ones there was site of service management. Definitely a huge one, right? Like I love the predictive side of things, and that's where I spend most of my time as well. But like, there's what I would like to focus on is a few of the examples that Travis gave there. There are just some very, very straightforward places where, due to the misalignment of incentives, people don't get the low-hanging fruit. If you see what I'm saying, right? Predictive is super exciting and there's a massive bolus of dollars there, but that's not necessarily low-hanging fruit. There's a number of things you have to do to get that to work. Site of service, I don't know what you think, Travis, but like, it's not actually that hard. You're like, hey, you're getting a scan. It's the same MRI machine. Do it there instead of there. It's exactly the same thing. It's just half the price. basically, right? And that's just because in certain settings, like there's a lot of control over the referral flows, what I'll say, and people will steer to their own radiology departments and they'll increase billing because of that. That's just inefficient from a healthcare economics perspective. There is no harm to the patient. In fact, that frees up dollars they might have on the co-insurance side that you could spend on other side kinds of care. Everybody kind of wins there. I think when we target with the value programs, we should be mainly starting with those kinds of things because those are the no-brainers, right? Everyone is kind of winning except, unfortunately, maybe the P&L, the radiology department. That might hurt a little bit. But that should be, those dollars should be routed to the health system in areas that add a lot of value, not just areas where they're offering a commodity service where they can do billing arbitrage effectively, right? And so that's where I would point to. That really resonated with me from the payer perspective of those are the kinds of dollars that you're going for, where it's a win for everyone and it makes the system more efficient.
Yeah, so in terms of order of operations, low-hanging fruit, whatever you want to call it, the transparency element seems to be something we've struggled with for many years, many decades, being able to do that cost comparison. We can do it everywhere else, right? We can cost compare vehicles, books, clothing, whatever it happens to be, very easy to do. But when it comes to healthcare services, it seems to be something that we haven't solved in any meaningful way.
Just very quickly, Andrew Toy hit on something very important. Imaging, a lot of private practices that are, I just recently had this discussion. A lot of private practices that are still standing right now. The only reason why they're standing is they have imaging services. Without that, they wouldn't be viable because they own the imaging services like the MRI and CT scans to where they can make money off of that. And I think that's about to get disrupted. So a lot of private practices now that are using that's what they're using in order to make money and for only to make them as, to make their private practice viable. It's about to change. So a lot of doctors are about to be institutionalized under an institution. It's just unfortunate, right? In terms of where that's going to be. And that's the low hanging fruit. In terms of getting predictive models, this is what this gentleman's trying to focus on. But the thing is, Andrew is working on that. And you need lots of money. You need a lot of investments. I mean, the amount of investments they went through just to get to that, they can't build. Good luck. You know what I mean? So that's kind of where it's at right now. So it's they need help. They need help, and potentially Clover could be there, right? And that's going to be good for us because we're about to be able to absorb that free cash flow. And imagine all the other Travis Daltons out there. Imagine all the other multi-plans out there that are burning in cash right now that they need help. And then guess what? We have our savior, Andrew Toy, there with his software.
I think to both Travis and Andrew, your points being that seems to be a place we can continue. It's not going to happen overnight, never has, but somewhere we can evolve to. But then, of course, more exciting down the line, talking about predictive analytics behind healthcare decisioning. That would be a really fantastic approach. And I know it's starting to find its way into certain healthcare practices, but will certainly evolve over a period of time. But I like that thought on what can we actually do today and solve for in the next, tend to think about things in the next 6 to 12 months. What can be actionable to start to make some shifts here? It certainly seems like the transparency element, Travis, that you identified, moving payers to the center with that model would be extremely helpful in that particular case. Along those lines of being more transparent when it comes to addressing health disparities and ultimately making sure that together we have a more equitable healthcare system, more access, more equitable outcomes. How do you think about that in the grand scheme of things? And we've talked about cost and transparency and quality, but when it comes to equity, how does that find its way into the center of what we've been discussing here so far? And Andrew, I'll jump to you first on this particular one, equity being a very vital part to healthcare overall. How do you think about that?
Yeah, for sure. I think that the way I think about it here is that, first of all, it's part of the mission to serve everybody. And that's simple. That almost is built into the word equity, is to serve everybody and to serve everybody as evenly as possible, right? That's number one. Number two, also built into the word equity is that not everyone needs the same amount of stuff. And I think that's very inherent to healthcare as well. Like some people are sicker, some people are less sick, right? And sicker people need more care than people who are less sick. That's the second dimension. And then when you chain that into the third dimension, health needs tend to correlate with socioeconomic status, certainly, and demographic status, which is generally supported, right? Between those two different things. I think that when you chain all those things together, it comes down to almost a capital allocation problem. Where are you going to spend your dollars? Because where you spend your dollars, as I just said, is proportionate to the needs of the person, and those needs are proportionate to their sickness burden, which is proportionate, again, generally to their socioeconomic status. Not always, obviously, but like roughly correlated. So when we think about how we break all of this down,
so again, so you can see how basically he's talking very fast. He's talking about proportionality. These are all weighted assigned things when we look at artificial intelligence. Like when we look at convoluted, let me just kind of basically let me just give me a second here. Convoluted neural networks, diagram, cat versus dog. Let's see if it pulls it up. So there it is. Okay, this is very good. This is very good. Okay, good. This will explain kind of what he's saying. And again, he's speaking in programming terms, but he's trying to say it in such a way that allows him to communicate to non-programming people. So assume, let's say very quickly, and I do research in artificial intelligence, so I have some form of an understanding here. Okay, so let's assume you have an AI, and the AI needs to recognize if this is a dog or a cat. Okay, and here's the picture, and we don't know. We know that it's a dog, right? But the AI system needs to be trained. So what ends up happening is you have these different types of nodal systems. Each nodal system is weighted from, let's say, 0.1 to essentially 1. And then, the ones that are weighted higher, in this case, it's highlighted, let's say, in purple. It recognizes that it is a 95 probability chance that this is a dog. We have AI models now that can essentially recognize that this is a dog, let's say, or let's say this is cancer, this is this diagnosis or whatever. So what he's basically trying to say is, if to tackle healthcare disparities issues, we need to look at this as a mathematical problem, looking at proportionalities by looking at the patient's overall diagnoses, looking at the patient's overall lab values, looking at the patient's overall clinical exam. All these are weighted in these AI analyses to a point where then we can say, does this person require more care than the others? And that's when Clover takes on that care, where they go to that person's house and they're able to basically offer more value-based care. And then that ultimately is going to decrease readmission rate, because then this patient won't go to the hospital, which will cost a lot of money. And that's what the cost savings is. This is just basically basic AI right now, using a convoluted neural network. Okay, they call them CNN, not the news anchor, but just convoluted neural network. So, or convolutional, right? So, just wanted to give you an example of kind of what he was saying. I'm gonna restart it. And sadly, I didn't share the screen here, so I'm gonna have to just tell you really quickly. Damn it! So you guys didn't see this. So this is a convoluted neural network, right? So there's an AI that's trying to recognize that this is a dog or a cat. Okay, so this is obviously a dog. We can recognize it because our brain kind of works similarly, right? You have these different nodal systems. Okay, so we're trying to train the AI model to recognize this as a dog and a cat. So each of these have different probabilities ranging from 0.1 to 1. And the ones that get activated that say it's a dog are the ones that signal to the node. And then it basically say this is a 95% probability this is a dog. This is a 95% probability this is a cancer or whatever, right? So ultimately, what basically Andrew Torrey is saying is looking at the clinical exam, looking at the overall element of the lab values and everything of a patient. Each patient has different needs in the healthcare system, and these needs need to be democratized to the sickest, and that's how you control costs, rather than everyone gets the same thing, right? And then when you do this and you have an AI model that helps with this, then you can basically start to decrease readmission rates, right? So that's what he's basically describing. Let's go ahead and let's go back here and let's kind of restart to what he's saying, and we can go a little bit more further here. Okay. All right.
Those things together, it comes down to almost a capital allocation problem. Where are you going to spend your dollars? Because where you spend your dollars, as I just said, is proportionate to the needs of the person, and those needs are proportionate to their sickness burden, which is proportionate again to generally to their socioeconomic status. Not always, obviously, but like roughly correlated. So when we think about how we break all of this down, generally, I think people will align to say that this is what we want to do as a society. How are we going to pay for it is unfortunately where it actually tends to break down. Like, how are we actually allocating those particular dollars? Because some people just look at the programs that we structure within the country, right? Medicare, Medicaid, the ACA, commercial, like we've named a number of these here, and most people don't know how to navigate between all those various programs. It's not clear that people who are actually even eligible for a certain number of these programs, to say Medicaid, are actually using all the benefits that they actually could use in those circumstances. Our programs are not maximized in those particular ways. So where we need to go to on the healthcare side is twofold. I say the part that we talk about a lot is, what care do you need? The part that we talk about less is, how sick are you? Right? And so I think that first one is naturally necessary to answer the how sick are you is necessary to answer what care do we need. But we focus very much, I think, on the what care do you need, and much less on how sick are you, right? Because generally we are a reactive healthcare system. And because we're a reactive healthcare system, we start at the point of diagnosis, and then that's when the value journey begins. My assertion is to deliver health equity, we need to push that and left shift it so that we are actually getting a much better evaluation as early as possible of everybody in terms of what their sickness status or the health burden is. And then that chains into analytics, predictive, all those kinds of things, so that we can deliver the right care. And then we can allocate the correct amount of capital from society to looking after.
Just very quickly, Mr. RUDL, if you go to the bottom left, is it the bottom left corner or whatever, you go to the screen, you can actually slow down the video and slow it down. And instead of having it play at 1 speed, you can have it play at 0.75 to 0.5 speed. And that should help, allow you to slow it down so you can normalize the speed, right? So hopefully that helps.
Those people.
Yeah, it makes
Yeah.
sense. And Travis, anything to add to that?
Yeah, I think that was comprehensive. I mean, I'll just add a few things based on my background. It's interesting to me. Equity equals access.
Yeah, that's very comprehensive because he gave it to you in a mathematical modeling sequence, and that's how the AI is trying to work.
In a lot of ways. So the ability to access care is something I think is like super important. And as I think about it, I think there are some really important topics and things to be done that are doable. My personal example, not to bore you with my personal example, but my mom worked for 35 years as an admitting clerk in a small community hospital in a rural community that I grew up in. And I tell people jokingly, the waiting room kind of raised me because we didn't pay for daycare. So she just took me there and I'd sit in the waiting room and people would just like look after me because they were friends and neighbors and members of the community. And it was really important to us that community hospital remained viable. One was it was the primary employer in the community. And secondarily, it was the closest point for care, the only urgent care within hundreds of miles. And thirdly, the cost of care by driving from there into the major metropolitan area was 10 to 20 times higher. And so I'm a big proponent of rural healthcare in the United States, remote healthcare and access for veterans and veterans care. And so I think that as you look at that, you're thinking, well, what is to be done about that problem? To me, it's high performing networks or targeted networks that allow access to in-network care across certain parts of the country. It's looking at using data to look at cost, price.
So again, he wants to help veterans. He wants to help rural communities. There's no focus. He's not focused. This is unfocused. There needs to be some focus. And that's why you can look at the company. It's just, it's not focused. Okay.
Geography, like risk profiles, and what is a fair and equitable price point for care, whether you're providing it rurally or not. So giving some leverage point to think about what the price point could be. And then the other is looking at how do we help drive pure hard ROI costs out of the health systems, meaning how do you design an employer benefit plan? I mean, we've got a technology-based product where we can come in and we can look at your benefit package for all of your employees. It's automated in a way that it compares it against all the options in the market and returns a smart card. And the smart card is the insight that says, do the following things and you'll have more benefit and less cost. Do that. And I always guarantee any employer I talk to, I'll drive 10 to 15% of your cost out in 1 month if you use the tool and you give us the chance. Those are all things that matter to us on the access and the cost side of the equation. And then I also think that registries are important as you look at that and you start thinking about certain registries, and Andrew mentioned it, but this idea of going from sick care to wellness, it's not beyond us with technology to understand populations, look at those populations and figure out proactive education and other ideas for outreach in order to impact care. So those are really, I would say, some of the things that I think about is, again, that rural access, veterans and the viability of care in those areas. And because I do think it's local and I do think access matters. And I do think it helps with quality and cost over time.
Yeah, that makes sense. That's great. Love the answer. Love the personal story.
No, I definitely agree. Access is important and everything like that. But the biggest issue right now is how can we use technology, right? That's the thing, right? It's technology enabled services. That's the discussion. Again, this is where we get back to, I'm in the room with sociologists, medical sociologists, masters in, MPHs, and, all these, I'm in all these things and they have all these wonderful ideas, but we need to remain focused, right? You can't, you know what I mean? So this is, and this is where Andrew is ahead. I mean, just look at his game face. This is where he's ahead, right?
Right there too. Always helps drive it home. So appreciate that. Maybe shifting gears a little bit to the regulatory side, such as shifts related to Medicare Advantage or telehealth influence. What are those influences on payer-provider collaborations, and what strategies can help navigate these particular changes? And don't use my particular call-outs of regulatory changes as the only one, but as you see regulation in the business, which is quite heavy for necessarily reasons, in other cases not necessarily so. But the question is really around regulation and what strategies can be used and implemented to help get through those regulations, or work with them rather.
Yeah, I mean, obviously we're a lot of experience on government programs from my side of things. I think there's a couple of different dimensions that I would put on here. First of all, when we look at the regulations, they're generally to protect patients, which make a ton of sense. And of course, you want to have those in place. Second of all, I would say that the regulations that control payers and the regulations that control providers, I would argue, are not very well synced. They were not designed holistically. They were kind of designed by two different sets of committees, which is understandable. Don't get me wrong. It just results in them not being holistic when you look at them together. And you're like, okay, like that could be done better. So I think that's definitely something we could improve. We could have one view on all of this and then regulate all together. Thirdly, I think it's a good thing, but it causes problems in the industry, is that there are different points of view within the country as to how we even deliver on value-based programs, right? Medicare Advantage, privatized payer, delivers value downstream from the private entity. Things like the MSSP, the Shared Savings Program, right, saves money for the country, but which is government directly going to providers, right? With ACOs intermediating. How do you actually design around all of these things? There is no central architecture for the country right now in terms of what is our view on how do we design those particular things. Now, I actually think that's a good thing. That might sound like a criticism, and many people sort of frame that as a criticism. I actually think that's a good thing, because no matter what people say, there is no perfect healthcare system in the world, right? I know here in the US it's very easy for us to be like, yeah, like when you look at that in UK, you travel all over. Like everyone complains about their local health system methodology in that country, right? Everyone has complaints about it. There is no perfect world. So I do believe that as technology comes, as AI comes, as data comes, whatever has been done so far is going to be replaced by something better. That should be our goal. Therefore, the goal is not to try and simply create the best thing for right now. It's to create the best regulatory environment for innovation while protecting patients. That's critical. But the best environment for iteration and innovation should be what we're going for, because what we know is with all of this data and technology advancements, we can do better than has ever been done in the world, and that should be what we're aiming for.
Yeah, and so Scott, I'm going to probably give what would be, Andrew gave a great answer. I might ramble at the risk of rambling, and I guess what I would say is, it's a political season, so.
Again, just rambling. It's just not. Again, even he admits it. It's. I hope you're seeing what I'm seeing, guys. Right? I hope you're seeing what I'm seeing.
I would just say, look, what doesn't help is rhetoric, false narratives, and politicizing things that aren't political. The mutual interest exists. So what I try to do is stay within the regulatory environment, but talk about the mutual interest of what we're trying to achieve, whether it's cost out or whether it's better reimbursements or what it might be. I also think it's okay for healthy tension to exist in markets. That's okay. And sometimes we should let markets actually work. I'm a capitalist. I want capitalism to prevail sometimes, because we're all highly regulated. But I also do understand that it makes sense in many different ways. And so for me, I'm a lot of what we're involved in thinking about, and sometimes we're asked questions about it. Our company's got a lot of deep expertise over a 40-year period on networks and out-of-network pricing and claims. We understand how to think about that, and also around transparency. And I think about that topic. I mentioned it a few times only because I think that transparency means transparency for all. And it shouldn't be, if you have the best tech, you win. If you have the best tech, you get the most margin. If we have an equal playing field of data and information, I think markets tend to ultimately kind of regulate themselves in a way that is good for everybody. And then you look at anomalies inside of market structures, like in our case, NSA, the No Surprises Act. I think that's interesting, and I think that made sense. And we're very supportive of that, and we created process around it. And I do think we should all work to avoid surprise bills, and we should work to make sure that doesn't happen. And so for us, we've spent a lot of time really focusing on, again, bringing geographic-based information data, taking MRF files and data that's provided, demystifying that, and just serving it up in a way that's useful information. So you can think about how to properly price on one side, and on the other side, how to properly risk mitigate. Same information can be used for both things. And when you do that, I think you kind of meet in the middle on a pricing point that yields value. That's kind of my view on it. And so I would just say that there's a lot to be done. I think it's an active conversation. I think it's smart. I think listening to each other is important. And I see a lot of really good things happen, and I see markets kind of self-regulate in some ways. But I think that the use of data and information can only help that. And we have more data and information in healthcare than we've ever had because of some of the past regulations that have forced digitization. So it's a fascinating discussion. We could spend a lot of time on this one, for sure.
Always evolving and always helpful. And I want to make sure we leave some time here for some audience questions. I could ask questions all day, of course, but wanted to open it up and see if we have any questions out there. So for the audience, feel free to pose any questions that you may have, and we'll be sure to post those up as we get them. But as those come through, why don't I ask one more as I wait for the questions to come through. We've talked a lot about what's innovation, collaboration, how that's coming into in terms of the payer-provider model. And since this is called Navigating the Future, really how we look at this collaboration effort 5 years from now. Andrew, how do you see this working out in terms of focus on collaborative efforts between payers and providers in 5 years? Do you see a lot of these things coming to fruition, or do you see it as more of a battle, a struggle, a challenge to be able to get there? I'm interested in your thoughts of really peering out into the crystal ball 5 years from now.
So I am extremely optimistic. I'm not just saying that because of the state of it. I'm just extremely optimistic because of the inflection point that we sit on right now from the perspective of where we are on the technology cusp, right? Travis mentioned this a couple of times about there are these moments, right? The ACA was one for digitization, which he's referring to. There are these moments on the technology arc where suddenly you make a lot of progress, I think, within healthcare at once. And I really do think AI is that for the world, not just for healthcare. And so that's why I have such high conviction. If I was betting on just AI in healthcare, I might have lower conviction. But if I was betting on AI in general and its transformative effect, I think it's a pretty good bet at this point. So I really do think that's going to be a really, really big deal. I do think we'll have a lot more tools at our disposal. And I really also...
I'm going to go ahead and just kind of restart this right now because this is actually really important, what he's saying. So let me just kind of go ahead and restart this, okay?
Struggle, a challenge to be able to get there. I'm interested in your thoughts of really peering out the crystal ball 5 years from now.
So I am extremely optimistic. I'm not just saying that because of the state of it. I'm just extremely optimistic because of the inflection point that we sit on right now from the perspective of where we are on the technology cusp, right? Travis mentioned this a couple of times about there are these...
So there it is. You know, we're at an inflection point, right? Where I think this is the beginning of an S-shaped growth curve. Now, for folks that don't know what that is, let's go ahead and say S-shaped growth curve. Let's go ahead and just kind of look at this real quickly here and just kind of share this tab of the screen. So we're like here. We're like really here, right? We're like in the beginning. This is the inflection point, and we're about to really get there, right? So we're going slow growth right now. We're like here on the slow growth, 11% per year, and then we're going to start getting to that crazy growth. Okay. So let's just kind of go back here. Okay. Sorry again, this live is taking a while, guys, but this is a 55-minute video, a lot. So sorry about that. But we gotta finish it.
Moments, right? The ACA was one for digitization, which he's referring to. There are these moments on the technology arc where suddenly you make a lot of progress, I think, within healthcare at once. And I really do think AI is that for the world, not just for healthcare. And so that's why I have such high conviction. If I was betting on just AI in healthcare, I might have lower conviction. But if I was betting on AI in general and its transformative effect, I think it's a pretty good bet at this point. So I really do think that's going to be a really, really big deal. I do think we'll have a lot more tools at our disposal. And I really also believe that the time is right where we can't really put it off very much further at this point, right? Like, I'm not saying we're at a breaking point, but we certainly don't have plenty of time in front of us to figure out what we need to do. So
what he's basically saying is that healthcare can literally bankrupt our GDP, bankrupt our country, and we need to find ways to decrease costs. Okay.
We're going to have more tools at our disposal. We're going to have more ways to figure it out. I think it comes from both a government perspective, which is my main area of expertise, but also Travis has mentioned employers a couple of times. There's only so much more employers can bear on the costs before they just have to do something. Have to do something. It's just fundamentally built into the economics. So we'll have tools, we'll have the will, because it's a little bit like not 11th hour, maybe like 10th hour. And I do think we'll make a lot of progress.
Yeah, and I don't live in the EMR world anymore like I did for 20 years per se. But I will.
So what is he mentioning? He used to work with the Cerner, Oracle, and the EMR. What does EMR stand for? Electronic medical record systems. Okay.
Say that it was like my earlier comment of if you think about it, it is complex, and we have seen a lot of change. But
how many times is he going to say the word "it is complex"? It is complex. That's just another word for him saying "I don't know."
There has been progression, right? I mean, in 2001, when I started, paper was the norm. Then data became the norm because we had digital records. Then interoperability became the buzzword to how you get data out of that. And now I'd say publicly available and open APIs are becoming much more of a normal standards-based way to look at information and share off it. So, my hope and my belief is that we'll continue. The companies are thinking about technology, thinking about the future, working closely together. Ultimately, think about this as an ecosystem. And it's not, sometimes it is our data, your data, their data. But in many cases, I think that data can be served up as platform-based assets for innovation as part of an ecosystem. And to me, that's a pretty cool thing that I think can happen over the next 3 to 5 years, which gets me pretty optimistic that you'll see some really cool innovation off of that. Someone in the garage with a great idea thinking about this will be able to get access to interoperable capabilities and data and open APIs to do cool stuff. From an innovator's perspective, I think that's kind of exciting.
Yeah. Definitely. And we are starting to get a flow of questions here. So why don't we try and get through a few of these in our waning minutes. Yeah. Do either of you see a payer enrollment compact similar to interstate licensure compact that makes enrolling in different plans across the country easier for groups that provide in-network care in multiple states?
I can probably answer this one. So I'll try and go quickly. This is a pretty deep topic. What I'll say is we already have a form of this, which is original Medicare, right? Original Medicare is a single participatory network across the entire country. If you are on original Medicare, not Medicare Advantage, but on original Medicare, you can go to any provider who's accepting patients and who accepts Medicare. So this already exists. It just doesn't exist in commercial ACA, et cetera. So the answer is, of course, we can do it. We already have it. it comes down to regulation, and it comes down to having a will to do it.
Great, helpful. See, we have another question here from Jessica. Thanks for the dialogue and insights today. Andrew, Travis, can you talk about the strategies to navigate the payer and provider relationship as it relates to timely data exchange? Getting and giving data timely and consistently is what enables actionable insights, predictable models, and proactive management. How do you recommend bringing payers and providers together to move away from a 3-month delay of data exchange? Great one. Thanks, Jessica.
I guess at least start with this one. I'm sure Travis has ideas too. I think thank you, Jessica. I like the way you framed this question, and I'm speaking from a technology perspective. It frustrates me as well. I will answer this from a payer perspective because it makes much more sense from a payer perspective of why we have this problem. And the reason is when providers are giving data to a payer, I'm a payer, right? They in no way think that they're giving me data. That is not how they think about it. What they are thinking about is, I want to get paid. And so our main source from providers, honestly, is not interop on the APIs or interop between the EHRs. It is the claim stream. And the reason they're giving us the claim stream is because they want to get paid, and they submit there. And so we are now subject to the delay of their rev cycle, not the delays of data interoperability. So it is actually a perception issue. We have asked for data before for providers, and they're like, oh yeah, we'll get around to filing the claim, right? And I'm like, no, I want the data. And people will say, oh yeah, but I haven't filed the claim yet. We need to move off of claim as the main way that the engine is driven. There are lots of technical solutions to this, by the way. It is that cultural dynamic where it is very difficult to accelerate because of that. So that's a very good answer.
Yeah, I think I'm totally with you, Andrew. I mean, I do think that.
And the best way to do it is say, hey, if you give me this data earlier, you get paid more. And then these doctors are going to be like, money. Yeah, they're going to basically do it, right? So that's pretty much what's going to end up happening. You have to reward them and say, if you give me the claim fast, then you might be able to get this award. But if you don't, it's going to cut down your X, Y, and Z. I don't know. It's very complex, right? But that's a really good question.
That cultural thing's interesting. I mean, we see like 500 billion records of MRF files and data. You've seen one. I mean, so it's this idea of, now, why is that? I don't know. I mean, one is, standard submission format, but secondarily, it's because you may not always want to share what you got. Let's just be honest. And so to me, anything like that culturally comes down to, I think there's kind of human interest thing. If you're going to do the minimum, unless you understand the benefit to you and your organization. And I think, how do you benefit? Who wins? What are some clear, specific examples to where you yield value from that? Those are things that all of us need to define. And I go back to Andrew's, I think, words at the beginning of common goal. If we can align on 2 or 3 common goals, I think you can really get behind the idea of putting your data out there in a way that might be useful. I think it's pretty interesting.
Great, that's super helpful, and we're going to run out of time here. I appreciate the audience with the questions, and hope to maybe come back and offer some answers to those as we get them. But really, I just wanted to thank Travis Dalton and Andrew Toy. I really appreciate your time, your insights, just a wealth of knowledge in such a short period of time. Again, I think we all pointed to, we can go on and on these subjects for a very long period of time. So I think for the time we had, it was truly helpful. Understanding payer-provider collaboration can be certainly transformational, as we discussed here. And it's clear that it's an absolute vital part as we continue to move forward and generate innovation and efficiency within the space. But for the audience, I want to thank everyone for joining us. Hopefully you left with some insights, some actionable takeaways to apply to your organizations. And hopefully you can stay tuned for our next session on AI and healthcare. It starts in about 5 minutes, but that ends our session here today. Thanks again, Andrew. Thanks again.
All right, excellent. So this is navigating the future of collaborative strategies for payers and providers. So, honestly, Andrew could have been on the other one too, AI and healthcare. So that's kind of weird they didn't put him on that one. But later on, people are going to basically start seeing that that's what they're doing. So overall, ladies and gentlemen, this is a great way for them to basically connect and other people in the question stream that are part, let's say, in a company that are trying to learn. Potentially, you have smart people like Andrew going to solve this. And I think I go back to this one here regarding in 2023 when he said 2023 and beyond, back to the statement and regarding the 10 years from now, we're going to basically see Clover Health potentially accrue the biggest market cap. And I know sometimes it may be hard to believe, but here it is. We are seeing a proof of concept where it's up 542%. And that's just 6 months. If I were to go back in April 30th, literally in Tuesday, back in April 30th of 2024, 6 months ago, and if I were to basically, we made videos on this, and people used to say, you spelt BS wrong, you don't know what you're talking about, this guy, doesn't know what he's talking about. That's what basically was filled of the audience, sadly. And if you were to look at now where we are today, we're up over 500%. And this is the proof of concept. And now all of a sudden now people are starting to say, wait a minute, I need to start reevaluating things because what I thought was reality wasn't the reality. And of course, this is why we teach in the Mastering Stock Market course access to the lifetime access of 2.5 billion outputs of institutionally graded data. We show folks that, hey, you can actually calculate the value of a company. So ultimately, I'm very excited where we are in this journey for Clover Health, I would say. And if it we I'm just really excited. Again, this is not using the overall what you call it SaaS like structure. But if we were to do 44 million of free cash flow multiplied out by, let's say, it's not because Q1 is 25 million, but I'm assuming for the year 2025 and 2026 and 2027, I assume we're going to get close to 176 million of free cash flow. And if we were to just keep it, let's say, growth at 11%, which we know is not the case since they just got upgraded to 4 stars. Um, you know, we can be at $8.68 from an 11% growth rate. So we know, right now we're at a bear case on average in near the recession case. So I think that in the future, I think that definitely we can go, and if we could just do 5%. So we normally take revenue multiplied by 5%, which gives you the free cash flow. So all you have to do is take 176 divided by 0.05. Clover would need to make $3.5 billion in order to get a 5% revenue estimation. But the problem is Clover's actually getting, their last quarter is, their last quarter is, was 44 million. So if we were to extrapolate that out, potentially we could see something like that. And if they were to grow, let's say 25%, then we could start getting at that level. And better yet, if they get to 35%, we could start seeing these types of levels. But let's just assume they're always going to do 44, let's say plus, 25, it's 69, 69 multiplied, let's say by 2, that 69 times 2, that's 138 million. So we could just say, let's just kind of do what they have. Or we could be very specific and say, let's just take 75% of that and let's assume the worst. We'll take almost like a 25% margin of safety, and that's 103.5 on the free cash flow. And if we were to, let's say, grow them at 11%, then we can basically start seeing kind of where the market sees Clover in the near term. But if this thing grows more than 11%, and if we get to 25%, then we can see $14. And if they go to 30% growth rate, then we can see $20, right? And then let's say, for example, they get to a percentage where they start growing really rapidly and they return to growth. But not like Oscar's growth of 45%, which will bring him at $54, but let's say maybe 40%, which will bring him at $40, or let's say maybe 35%, which will bring him around $28, which is right around their investment packages. So ultimately, when the time happens, when the time comes, we're going to see their growth rate, and we're going to ultimately see where they're going to be at. And this is not, using SaaS, because we haven't gotten the SaaS revenue yet. We haven't even gotten the free cash flow from SaaS, which is a high gross margin business. This is just basically utilizing and extrapolating what they've generated in the past 2 quarters. Q1 of approximately $25 million in free cash flow, Q2 of approximately $44 million in free cash flow, and extrapolating that out to 138 million, but taking a 25% margin of safety cut, getting you 103.5, but then upping the growth rate, because if they do return to growth because of their 4 stars, this is what we could see. So ultimately, I'm very optimistic. Again, this is an educational platform. This is not financial advice. Take this as a grain of salt, right? But ultimately, if you want to learn kind of what this is and how we do this and how we've made so many folks essentially from using our platform, many people have become multimillionaires, I highly recommend you join our platform using the coupon code Main Street, which will take $600 off lifetime access, which you can inject in the coupon code section at alstocktrades.com. Right. So again, guys, it's always an honor being able to provide this. Again, we're staying late today. It's definitely late, but it shows the conviction that I have in this company. Really, I really do. And ultimately, I'm just very excited to see kind of where this goes. And we're going to see some great things. And ultimately, I agree with what Vivek says, and I'll end it here. In 10 years, I strongly believe that it is possible for Clover to have made the biggest positive impact in healthcare, while simultaneously accruing the largest market value in healthcare in excess of any healthcare company that exists today. Ladies and gentlemen, I love you a lot. Yes, it's late. My wife is waiting. My apologies, guys. Well, let's get you to your wife. Have a wonderful day. God bless you all, and I'll see you on the next one.